In investing, you need to avoid common beginner mistakes. There is no need in committing a mistake if you already know about it. One of the most common mistakes is putting all of your eggs in one basket. This translates into taking all of your hard-earned money and buying only one or two stocks. With four or fewer stocks in your holdings, you become much more vulnerable to potential issues. Imagine if you only own stocks in two companies and one of the companies experiences issues in maintaining profitability. The company's issues ultimately leads to bankruptcy. At that moment, half of your money is more or less gone. If you had owned 10 stocks instead, only 1/10 of what you owned had vanished. Such a loss would total 10% of your total portfolio and could be recovered within a year. However, losing 50% of your portfolio would take many years to recover. Not only is it important to own stocks in several companies, definitely more than 5, it is also important to conduct the correct form of diversification. If you own 6 different stocks, but they're all based in the same industry, say being producers of oat milk, the once very trendy drink at coffee shops, you haven't diversified anything with regards to industry, but have put all of your eggs in that the oat milk demand will be as strong in the future as today. A wiser approach would be only having 1 out of 6 stocks within the oat milk industry, while the other stocks would be based in, for example, pharma, automotive, tech, and real estate. In this way, you safeguard yourself against one industry becoming weaker over time, as one industry becoming weaker can be mitigated by other industries in the portfolio becoming stronger. Combining stocks from different industries is the most logical thing to do. However, many first-time investors neglect the fact that some companies are more sensitive to the overall mood of the economy. If you choose industries that perform very well when the general economy is good, you will see good returns on the portfolio in a booming economy, but very low returns when the market subtracts and becomes a bear market. Generally, industries such as automotive are cyclical, meaning that they are more sensitive to market variations. When the market is in a good mood, people have more money and buy new cars. When the market declines, people start to lose their jobs, and with higher inflation, people are more reluctant to buy new cars, so the sales of automotive companies decrease. On the other hand, industries such as the pharma industry are non-cyclical. No matter the market situation, people need their medicine and will continue buying them even in a bear market. Not understanding the business of selected stocks is very common and a recipe for failure. Very often, investors make the mistake of investing in a company despite not really understanding its fundamentals and business model. Not only is this valid for beginners in investing, but even experienced investors can base their decisions on statistics rather than understanding the business and its viability in the long term. Warren Buffett sums this up quite well in the following audio.
I have an old-fashioned belief that I can only should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know in general what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. That evaluating that company is within what I call my circle of competence. I understand what they do. I understand the economics of it. I understand the competitive aspects of the business. But the biggest mistakes we make.
In order to understand the economics of a business, you need to read the annual reports. You should understand how management thinks, see the history of the company, and how projections that were stated by management actually turned out. Do they succeed with their business strategies? What do the numbers look like? Is the company making more money each year or losing money? You should understand how one part of the business is connected to another. How does a sale of the most popular product take place? Is it probable that it will continue like this for many years? How is the product produced? Is the company dependent on many other companies for its products? Or is it self-sufficient on a necessary level? How vulnerable is the company for new technology? Is it easy for the company to keep up to pace with new technology, and why? What makes the company strong or weak? If weak, could it turn around or not? If strong, what are the factors that say it will remain strong? Not being patient. Many first-time investors are impatient and cannot stand to see the market share of a stock fall below the purchase price of their stock. Upon seeing a, say, 10% theoretical loss on their stock purchase, investors tend to sell the stock as soon as the stock recovers a little bit and approaches the initial purchase price. Buffett couldn't be more right when he stated, "The stock doesn't care about your existence, nor does it know of your existence. You are nothing to the stock." The stock will fluctuate in both directions. The most important thing is to hold on to the stock long enough, at least a few years, and it will show its true value. This presupposes that you have done your research and that it's a good underlying business that should increase in value over time. Timing the market. This one is one of the major reasons for new investors to actually never even enter the stock market. They identify a stock and seek to purchase it, but as they wait a few weeks, the stock price increases 10 or 20%, rendering it expensive to the new investor. The investor then waits, hoping the stock will decrease in price, but only in vain. The stock continues to increase as more investors see the stock's true value. The stock is now up 40% from when it was first identified by the new investor, but the investor still doesn't own it. An important lesson is that you cannot time the market. Studies have shown that from all portfolio returns, only 7% stem from timing the market decisions. In 93 out of 100 cases, it's better to buy the stock and not wait until its price decreases. Following the flock. Last but not least, following the flock behavior in the stock market has been a disaster for many investors, both beginners and experienced ones. Once your neighbor, a lad, or even colleagues brag about earning $50,000 in a week on IT stocks, you become inclined to join the race in order to not miss out. The fear of missing out has caused many financial bubbles. When everyone else seems to buy a house and they rise 10% in value yearly, you want to buy a house yourself and see it rise in value as everyone else is experiencing. However, following the flock comes with devastating behavior similar to gambling. You are buying stocks or other assets that you haven't properly analyzed. The stocks might be overvalued with actually no profitable products at all, but leverage on the belief that they will be profitable in 10 years from now. When people finally realize that the stock is useless, it is too late. The stock plummets in value as everyone is eager to sell and minimize their losses. Never follow the flock. Always do your own thorough research and don't get dragged into gambling behavior in the stock market, especially not by your neighbors. Avoid these 5 common mistakes for investing success. Make sure to subscribe to the Smart Investing channel for more videos about investing.